Scott, also new to the board of Volkswagen AG, the CEO of the Audi AG, and responsible for premium on the central board of management. Then Stefan Sommer, also a new member of the group board, responsible for components and procurement. Then Franz Witter, you all know him, the CFO of Volkswagen AG and the CEO of the company Herbert Diess. First, we will hear a series of presentations, and then there will be opportunity for any questions that you may want to ask. So let me now hand over the floor to our CEO, to Herbert Diess.
Ladies and gentlemen, the cars are gone. Can we have the cars again? Ladies and gentlemen, welcome to our annual media conference here in Wolfsburg. It's great. We have the opportunity today to talk about our business results from the past year and what I think is also important, to look ahead to what the future holds. The transformation of our industry is picking up pace, and we are striving to provide individual mobility for the years to come, and also for millions of people across the entire globe. And the challenge is to ensure that this mobility is even safer, cleaner, fully connected, and above all, carbon neutral. And we are seizing this opportunity for change, and we aim to take up a leading role in the new world of mobility as well. And this is also why we, 3 years ago, started the process to realign our group, and we're now completing the first stage of our journey. We are aligning Volkswagen with e-mobility like no other company in our industry. And to a large extent, that is also reflected in our planning. We're also starting to evolve from being a pure car maker to being a software-driven company. In order to shoulder these investments that are required for this, we're now boosting our efficiency in manufacturing, in sales, and in administration. We're becoming more agile and more innovative. But still, we are aware that we have to become even faster. It's our new competitors that are setting the pace. Ladies and gentlemen, Volkswagen will change fundamentally. I think this is something that has become clear over the last weeks and months, and some of you may still be rubbing your eyes in amazement, but there's no question this supertanker is picking up speed. We're addressing the key trends of the future, particularly in connection also with climate action. We are taking on this leadership responsibility with our global footprint, with our strong brands and operative strength. A look back at that last fiscal year will underline the truth of my statement. 2018 was a successful year for the group. We have performed well despite the strong headwinds and major challenges. This success is reflected in the 10.8 million vehicles delivered. The more than 70 new models launched by our brands were well received by our customers, particularly the numerous new SUVs such as the Volkswagen Touareg, the T-Roc, the Skoda Karoq, the Seat Arona, and the Audi Q8. And the trust of our customers is also reflected in our financial figures. Our sales revenue rose by 2.7% to 235.8 billion euros. Operating profit before special items increased slightly to 17.1 billion euros. The negative special items were on the same level as the previous year at 3.2 billion euros. And these are mainly attributable to the diesel issue. Before special items, the Volkswagen Group achieved an operating return on sales of 7.3%. So this result is at the upper end of our target corridor. Now, more details about our business performance you will hear shortly from Frank Witter. Now, as these results show, we are one of the few car makers that was able to meet its annual forecast in the operating business side. Our operating business is robust, it is resilient, even in times of great uncertainty. Now, examples of this uncertainty include the ongoing trade dispute between the US and China, the still unresolved Brexit situation, exchange rate fluctuations, and signs of an economic downturn in many regions of the world. The greatest challenge for us in 2018 was the changeover to the new WLTP-based type approval process for our vehicle fleet. In Europe, this new test procedure led to a downturn in sales and a loss of market share, particularly in the second half of the year. There were delays in delivering numerous vehicles to our customers. Our complex portfolio also meant that we were more seriously affected than our competitors. And not only that, but our own preparations could also have been better. Audi was particularly hard hit. It will probably be the end of the first quarter before all variants are available again. And we had to fight to produce every single car here at Volkswagen Brand too, right up to the very end of December. I have great respect for the team effort it took to achieve these results. And this is particularly true for our engine developers who had to work more or less around the clock. WLTP will continue to be a challenge in 2019. There could be some temporary restrictions once again, but these will be much less extensive than in 2018. And we have learned our lessons. The VW brand has reduced the number of its model variants by 25%, and by Audi at 30%. And that streamlined portfolio that helps us to improve our productivity, lower the manufacturing costs, and reduce fixed costs at the same time. We have, of course, increased our test bench capacities, and we have built up personnel to ease those bottlenecks. In Europe, we delivered a total of 4.4 million vehicles, which is 1.2% more than in the previous year. The overall market in China, after a positive start of the year, has shrunk sharply from last June, but for the first time in more than 2 decades, there was largest single market reported now negative growth rates. But still, we have achieved a new delivery record in this challenging environment, and we have grown our share of the market to 18.5%. Additional potential in the market that continues to decline will come from our new Jetta brand. It will directly target the rapidly emerging young middle class with its high quality, with its safety, emotionality, and attractive pricing. China is now setting productivity and quality standards for the entire group. It is setting the pace with regard to innovation as well, for e-mobility, for digital and new mobility concepts. So Volkswagen's future hinges on China. China is our single most important market and will remain so. And this was also a reason for strengthening its board-level representation. Stefan Wallenstein, CEO of the Volkswagen brand in China, is now also a member of the brand board of management. In North America, unit sales dropped by 2%. This was due to exiting unprofitable market segments in Mexico. In the US, we were able to increase deliveries, however, by 2.1%. We are gradually making progress thanks to new models, such as the 5-seater Atlas SUV. The turnaround is scheduled for 2020. That has not changed. We are expanding our plant in Chattanooga so that it can produce vehicles based on our MEB, our modular electric drive toolkit. This 700 million euros investment represents a clear commitment to the US market. This transition to e-mobility also gives us the opportunity to significantly expand market share and then also reposition the brand in the United States. There have now also been positive developments in South America as well, with a rise in unit sales of more than 13%. We are now back on track after some dramatic restructuring in Brazil. The attractive new products that are superior technologically, such as the Polo or the Virtus, that have brought us this positive momentum. And we are intending to move back into the black this year with new models, such as the T-Cross, which will be coming to the showrooms in just the next few days. The ongoing economic crisis in Argentina has led to losses, but here too we have initiated countermeasures and are now working on new locally produced vehicles tailored to the market needs. Ladies and gentlemen, the success of the Volkswagen Group is a global achievement. It is made possible by the efforts of our 12 group brands. And all of them are striving tirelessly to enhance their future viability and performance. And we have improved in almost all brands and regions in the past year. And I would like to express my sincere thanks for that to our teams. Our core Volkswagen brand has achieved new record figures in unit sales and sales revenue. Now, the task today is to steer the changeover to e-mobility with the MEB while improving the cost effectiveness of the MQB at the same time. So progress has already been made in this regard, above all in containing our fixed costs. The brand has brought its 6% target for return on sales forward to 2022, notwithstanding all the high costs that still are required for necessary future investments. But there's still quite a backlog in administration and production and development. Now, we will tell you how Volkswagen is switching to be leaner, more efficient, have a more digital way of working in the future tomorrow at the brand's press conference. Skoda is continuing its excellent development. The brand grew once again in 2018. The plants are operating at more than 120% of capacity now, and this is why we're planning to build an additional multi-brand plant in Eastern Europe, and we're currently looking at sites in 4 different countries in that area. To an increasing extent, Skoda is also taking over tasks for the entire group. Skoda is leading group activities in India and Russia, or in the future also, they're leading the production of the Passat family at the plant in Kvasiny in the Czech Republic. But still, Skoda needs to work on its return on sales, which has dipped recently. Seat is also rapidly picking up speed with a convincing annual result. The brand was able to increase its vehicle deliveries by 10.5% to 518,000 vehicles, making Seat Europe's fastest growing brand. It's also the brand that attracts the youngest customers as well within our group. Now, Seat has also taken on the responsibility to generate a return on investment at group level. Now, the return in 2018 was already 12.5, not far off the group target. And also, the return on investment, incidentally, will in the future be our most important performance indicator in the future, even more important than return on sales. Now, also, Volkswagen commercial vehicles are on the right track. The brand has set itself what are perhaps the most challenging goals and projects within this group. The conversion of the Hanover plant to an electric production location is an important strategic decision. And also, the recently agreed collaboration with Ford opens up new horizons and growth opportunities with regard to mid-sized pickups, for example. Volkswagen and Ford will be using a joint platform for the successor to the Amarok, and we will be making a decision on the production location of that product soon. And then we're also consolidating the group's activities in new mobility services, such as Moya, with VW commercial vehicles. And this is also true for the development of fully automated vehicles, also referred to as robo-taxis. For Audi, 2018 was an extremely challenging year. I've briefly touched on the impact of WLTP. That brand was especially hard hit as a result of its complex drivetrain portfolio and the ongoing diesel retrofits, and this was also compounded by a change in leadership. But looking forward, we see excellent opportunities for regaining the initiative. It's worth bearing in mind that an operating profit of 4.7 billion euros and a return on sales of 8% still represent very respectable annual figures for Audi. The Audi team is powerful. The product pipeline is nicely filled. The new management team, headed by Bram Schott, will refine and implement Audi's transformation plan too. The recently presented electric SUV, the Audi E-Tron, is truly an important milestone in the brand's electric push, and it's the first genuine alternative to Tesla in the premium segment. Up to January this year, 20,000 reservations had already been received. The first dealership presentation of that vehicle was so successful that all the test drive slots were booked within the first 16 minutes. Our colleagues at Porsche once again enjoyed a record year with regard to unit sales, sales revenue and earnings. The 8th generation of the 911 will be the best of all time. And it has been critically acclaimed. Preparations now for the first all-electric Porsche are also underway in Zuffenhausen. The Taycan will be the sportiest electric car on the market, opening up great potential. Here again, 20,000 prospective buyers have already expressed their serious interest in that vehicle. For Porsche, the most challenging task is now to continuing to achieve a more than 15% return on sales despite their transformation to e-mobility. Our truck and bus business has also been positively developing. Sales revenue across all brands rose by 6% to 25.9 billion euros. Adjusted operating profit increased by about 13% to approximately 1.7 billion euros. The new independent entity, Traton, has the potential to become a global champion. And it is currently making preparations for the initial public offering. A date for this IPO will be agreed in the foreseeable future. But the conditions on the money markets and capital markets have to be right. So we're weighing things up and assessing the situation over the next few days. Ladies and gentlemen, alongside the successes achieved in our operating business, 2018 was also marked by important strategic decisions. In April, the group was given a new, leaner management structure. This also means that we spread responsibilities across more shoulders than before. Decisions are now made at the lowest responsible level, as close to the actual operations as possible. The motto is that a lean group should drive strong brands. So that is the principle also that guides the work of the brand groups in the future. In addition to this, there are individual brands that are assuming responsibility for specific regions. So what that means is that the group is taking care of the major synergies, the MEB, the MQB, the PPE modular toolkits, the product portfolio, our plant assignment and purchasing. But we're also breathing life into this new structure on an HR level. So nearly 40 top positions at group and brand level have been reallocated in the past. For example, we now have Gunnar Kilian on the board of management as our HR officer, and Stefan Sommer for components and procurement. Bram Schott is now the Audi CEO, and Ralf Brandstetter, the COO of the VW brand. Now, moving forward, we intend to fill more top management and board positions with candidates already working within our group. And with this in mind, we have introduced a new executive-level training program in which almost 400 managers from across the entire group will be participating. We're also revising the management remuneration system. The bonus will be oriented to group earnings. The rise in share price will become an important parameter. So the focus is now on group targets, and that is also done with a view to fostering collaboration. Our managers would also play a key role in the process of realigning our company culture. Now, despite the progress that has already been made, much work still remains to be done on this topic, and work that goes far beyond the diesel crisis. In the meantime, 99% of the affected diesel vehicles in Germany have been fixed. Nevertheless, what we need now is to install a culture in which integrity and an open approach to dealing with mistakes and problems are a matter of course throughout the entire group. Our independent compliance monitor, Larry Thompson, and his team are helping us with these endeavors, and I would like to take the opportunity to express my gratitude here. Working together with the compliance monitor, we intend to make Volkswagen a better company. And all in all, we are making good progress, and we remain on schedule. We've already received now the monitor's second report, and we are implementing the recommendation it contains. Now, a further key lever for our future viability will be alliances with third parties. In one such alliance, we're working with Ford to develop vans and mid-sized pickups. And discussions about further possible collaborations in the areas of e-mobility and autonomous driving, we are already at an advanced stage. Now, we have also entered into a partnership with Microsoft to develop the Volkswagen Automotive Cloud. The restructuring of our group components is a further key pillar of our strategy. As of January 2019, Volkswagen Group Components is working as an independent business unit within the group. So from scratch, we have created one of the world's largest suppliers with a business volume of some 35 billion euros and over 80,000 employees. And in this unit, we also have consolidated all activities related to batteries for electric vehicles. We're now focusing on particularly the battery value chain for electric vehicles, from commodities and cell production all the way to the use in vehicles and in a second stationary life cycle. And then finally also all the way to raw material recycling. Now, components will be optimizing all of this, much of it using its own resources. The MEB components, such as battery cells, electric motors, power electronics, or drivetrain units, will also in the future be available to third parties. And, last but not least, in our most recent planning session, we also have created other important foundations. We have reorganized the way our plants are utilized. To support our electric push, we want to make more factories, sites producing solely electric vehicles. We also made the decision to reduce the size of the workforce at our German sites in a socially acceptable manner. And you will be hearing more about our electric campaign shortly. But first, Frank Witter will now give you more details about our business performance in 2018. Frank.
Thank you very much, Herbert. Good morning to you, ladies and gentlemen. Let me first of all apologize for not attending last night's meeting because I had to look after my own voice and the effects that seem to be coming. So if I'm clearing my throat every now and then, this doesn't indicate anything. This is just really due to the cold I have. I'd like to make the statements I'm making as directly as possible. That's why I'm pointing this out. We've already made the numbers available by the end of February, and now we have the annual report, and I'm happy to report the financial figures in detail to you today. I think we can say in 2018, the Volkswagen Group was in a very difficult environment and maintained its position. A very difficult environment. This includes many different issues, the trade political tensions we experienced, the Brexit issue, and the result we may get from this tonight. And WLTP is a keyword everybody knows by now, but it's also about the effects of transformation in all of our industry. So we're very satisfied to say that the sales revenues of the group at 235.8 billion euros did in fact increase 2.7% over the previous year, meaning a new record level. Then the question is always exciting of what were the major driver, and what was certainly positive, and you know this from the 9-month figures, were the volume effects and the mix effects, but also the business growth for Volkswagen Financial Services and for commercial vehicles. What had a very negative impact was exchange rates. All in all, this was 4.8 billion, and without hedging, in fact, this number would have even been much higher. The currency that gave rise to particular concern was in South America with the Argentinian peso, the Brazilian real, but also the Turkish lira right in front of our own country. But the US dollar also had impact. So the operating result before special items is at a good level at 17.1 billion. But it's also part of our annual financial statement that we didn't manage without negative special items. It once again 3.2 billion, so this is the same level as in the prior year. And this is exclusively due to the diesel issue once again. This includes things like the fines imposed by the Braunschweig prosecutor's office amounting to 1 billion, or from the München prosecutor's office amounting to 800 million. But there were also increased legal risks and costs of defense, and also costs for technical measures to be taken. So the operating return before special items was at the same level as in the previous year at 7.3%. And we're glad that we're in the same corridor as indicated in our guidance, which was 6.5% to 7.5%. In fact, we even ended up in the upper part of this range. So I think we can claim that we delivered. It's also exciting to look at the operating earnings, 17% to 17.1%. You might say it's been a long year and not a lot has happened, but this is not the case. Let me begin with the passenger cars division here. The main driver is volume and the mix of the vehicles delivered, and also the pricing were important at 1.4 billion. This was an important contribution, but also at the cost of products we made progress amounting to 300 million. Exchange rates, this doesn't just play a role for sales revenue, but also for the operating result. At 300 million, it was a charge and an increase in fixed costs. This was 1.6 billion all in all, and this is mainly due to the depreciations on the high capital expenditure of the previous years. But it's also due to the cost of our research and development, which we're spending today for new things like new models, electrification, and also CO2 improvements on internal combustion engines. It's also important to point out that IFRS 9 has been changed. So as of 2018, valuation effects on derivatives and the costs of hedging are no longer reflected in the financial result, but in the operating result. All in all, this amounted to 900 million euros as a charge on the operating result in 2018. Let me now turn to the commercial vehicles business, an improvement of 100 million. And the volume development was positive, especially in the European and Brazilian markets, which are so important. The recovery is quite clear. And we've also made some progress on the volume mix, and the exchange rates across all the markets in total were positive. Cost increases were absorbed successfully. In the power engineering business, we're pretty much at the same level in the operating loss. As in the previous year, we had some positive effects, but they were offset by a deterioration in the mix. In the financial services division, the operating profit was stable, especially the positive growth of the business is to be mentioned as a positive thing, but also the work done on cost. Still, we must say that despite a continuing demanding environment, the result of the group at 17.5 billion is at the same high level as in the previous year. Let me now give you an overview of the results of some individual markets. Apart from this, I would like to refer to the special events organized by my colleagues on their brands. 2018 is characterized by two pretty different half years. The first 6 months in terms of volumes and sales and return were extraordinarily good. As expected, the second half of the year was clearly more difficult. First, the overall market development slowed down somewhat, but it was also the new WLTP WLTP test procedure, which also left its traces on our brands and especially on Volkswagen Passenger Cars and Audi and Skoda, and also on some other brands who were able to overcompensate this to some extent, but it was a major charge on all our passenger car brands. Let's look at Volkswagen Passenger Cars. The operating profit before special items is 3.2 billion euros. This is a return of 3.8%. This is approximately the same as in the previous year, where we were at 4.2 billion. The good return is due to the further rollout of SUVs. We were also able to increase sales volumes, and we made good progress on costs, but it was a difficult year, so the cost of sales, especially the environmental bonus, increased clearly, and there were also negative exchange rate effects, which left their traces. The investments in the future are important, and these were also important to the Volkswagen Passenger Cars brand, and it was also WLTP, which was important. And there were some special items from the diesel issue. This applies to Volkswagen Passenger Cars and Audi. For Volkswagen Passenger Cars, it was 1.9 billion after the 2.8 billion of the previous year of 2017. Let's turn to Audi. The operating profit before special items was 4.7 billion. All in all, this is about 7% below the previous year. What was positive was improvements in the mix, positive exchange rates, and product cost optimization, but there was lower sales volume, and what's particularly harmful here is the European development, higher cost of sales, and especially WLTP effects, especially bearing in mind how important the fleet business is to our colleagues at Ingolstadt. But we also have to be aware of the increased depreciation on the investments of the previous years. The operating profit before special items was reduced from 8.5 to 7.9%. It's slightly below our corridor of 8 to 10%. Audi had 1.1 billion of special items, all of this resulting from the diesel issue. Then Skoda, Herbert Diess mentioned it, 1.4 billion operating profit, 14.6% of return. This is something that's certainly presentable, but it's worse than in the year before. It was due to exchange rate effects, but also to the sorry topic of WLTP, and it was also due to investments in new products. So growing sales and the improved price positioning was not enough in order to maintain the previous year's levels. What we didn't enjoy so much was the results of the Bentley brand last year. All in all, it was a negative 288 million. This is a clear deterioration compared to the 55 million profit of the previous year. So this was quite clearly the result of the Continental GT, the volume car of the Bentley brand, which was clearly delayed in its launch, and there were exchange rate effects, which had a negative effect. And it's also part of the history of 2018 that we had a one-off item of 68 million euros as a one-off from a change in the local pension funds. And then last but not least, it's clearly more fun to talk about Porsche. The operating income once again improved by 2.7% to 4.1 billion over 2018. This didn't look at it like this at all, that we would be able to absorb WLTP and other issues so well. In fact, we were able to deliver even more vehicles and to improve the mix sensationally. This was enough for being able to spend on future issues and, in fact, to overcompensate this and to achieve a return of 17.4%. This is beyond our strategic guidance and just slightly below the previous year. Let's then turn to China. I would be happy if we could include this number in our operating income, but this is reflected at equity in our financial result. But nevertheless, China remains an extremely important market to us. Deliveries, and this in a market which, as of the middle of 2018, deteriorated, we were able to increase by 0.5% to 4.2 million vehicles. The operating income at 4.6 billion was only slightly below the previous year, and in fact, this is easily explained by exchange rates. So basically, we were at the same level as in the very successful 2017 fiscal year. Mix and volume took a positive development. The cost of products has been optimized further. In fact, this is a challenge and a task everywhere. But the competitive environment in China has also become extremely demanding, and we also got to feel this, and the exchange rate effects were also a reason for this. So in this respect, this result is important, but it's only reflected in our financial result. So let's turn to this now directly. The financial result increased clearly to 1.7 billion. This is a swing against the previous year, 2017, of 1.8 billion. And there are always three major drivers for this, three major chunks. First of all, the result at equity. The major contribution comes from the Chinese joint ventures, SAIC and FA. Volkswagen, they were even slightly better than the previous year. We had a positive one-off effects in 2017 of 182 million because we took in further investors, and this led to a new valuation of shares. If you compensate for this effect, the result at equity was very good, also compared to the previous year. The interest income, the second important column, this improved by 786 million. This is mainly due to lower interest payments, and the rest of the financial result is also about 1.2 billion better. This is mainly due to currency-related valuation effects of receivables and payables, which had a very positive development, and also lower spending on the measurement of derivative financial instruments. But a large portion of this is now reflected in the operating result, as I pointed out. We have a clearly improved financial result, improved by 1.8 billion euros. Let's now take another quick look at the year with its highlights. The operating result in 2018 is at 13.9 billion euros, so even after the special items mentioned, it's at a good level. The financial result is now at 1.9 billion. Income before tax is 15.6 billion euros. It's 2 billion better than the previous year. And the tax rate, that's also worth mentioning, it's now at 22.3%. Let's not forget that 2017 was distorted in its result, probably not just for our group because of the US tax reform. We had a positive valuation effect of 1 billion euros, and this, of course, is a one-off item. So we're now normalizing again with our tax rate. Profit after tax is at 12.2 billion, 700 million above the prior year. For the fourth quarter, for those of you who are interested in detail, let me refer you to our investor relations website. Herbert Diess mentioned it. If apart from cash, there is one number which is important. It's the return on investment, which is worth looking at. It's a value-orientated management concept, reflecting the replacing the after-tax, or dividing the result after tax by the invested capital, and this expresses whether we are using our capital well and responsibly. So we traditionally also proportionately include the results of the Chinese joint ventures. In 2018, and you will not be surprised by this, we had increased invested capital, we had higher inventories, but also increases from capital expenditure and capitalized development costs. And there were also special items which need to be taken into account, but we had a return on investment amounting to 11%, which was above our minimum expectation of 9%. But it also is our objective and our target to be above 15% for the group. Net cash flow was mentioned, and one important measure of our economic activity and of our success. Net cash flow is really the surplus from current operations. Let me take a quick look at capital expenditure, which was above the previous year as expected. It was 13.2 billion euros, or an increase of 4.6%. We mainly spent here, and this is mainly our models, but it's also the production capacities. Without these investments, we wouldn't be able to present these great models to the market. Herbert Diess mentioned them, like the Continental family, the Touareg, the T-Cross, the Audi E-Tron, or the Taycan of Porsche, and I could even expand on this list. The capital expenditure rate, that is, what share of our revenue does capital expenditure amount to? It was 6.6%, at the same level as the prior years, and it was well within the corridor we had predicted of 6.5 to 7%. At minus 0.3 billion euros, net cash flow is clearly better than the previous year, but it's also part of the 2018 fiscal year that in the fourth quarter, due to WLTP, we were not able to reduce receivables and inventories even more. If you also add the 5.3 billion paid out on the diesel issue and also our M&A activities, 0.6 billion euros, the net cash flow within the automotive business was 5.6 billion euros. What's also important is that for the transformation of industry and for the imponderabilities of the operating business, you need sufficient net liquidity. And this brings me to the automotive business, and this is mainly influenced by net cash flow, which was at minus 0.3 billion euros, as I pointed out, the operating business, and the inflow of dividends from China. This is about 3 billion euros. Unfortunately, this was offset by the diesel payouts and the WLTP effects, which resulted to an increase in inventories and receivables. Further variables that influenced our net liquidity was the issuing of hybrid notes amounting to 2.75 billion, whereas the redemption of another note was 1.25 billion, so the positive impact was 1.5 billion. MANSE shares, some compensation payments had to be made, and this led to a negative 2.1 billion as of the 31st of December, all as a consequence of the award procedure. Also, the payout of the dividend needs to be mentioned here, and the shareholders of Volkswagen AG received 2 billion, 1 billion more than in the previous year. So all in all, there's still a very sound number of 19.4 billion is the net liquidity of the automotive. After the payout is before the payout, the result of the shareholders was 11.8 billion euros, 600 million more than in the previous year. This means an undiluted result of 23.57 euros per regular share and 23.63 euros per preferred share. So the Board of Management and the Supervisory Board propose a clearly increased dividend for 80 per regular share and 4.86 per preferred share. This is a payout ratio of 20.4%, clearly better than the 17.6% from the previous year, adjusted for the tax effect. And, ladies and gentlemen, we still focus on our strategic target of 30% for the payout ratio. On May the 14th, there will be the annual general meeting in Berlin, as announced. The agenda and all the other associated documents can be found on our investor relations website as of today. Ladies and gentlemen, the numbers of 2018 show that in a challenging environment, we have achieved a position from which we can now successfully manage change within the Volkswagen Group. 2019 will not be easy, though, but we're optimistic and we're firmly determined, ladies and gentlemen, to achieve the targets we've set. And this brings me to the guidance for 2019. We expect that the deliveries will slightly increase the previous year's level, but let me hasten to add, if we had written 6 months ago the same thing, we wouldn't have said slightly. Of course, there have been slowdowns in various important markets, but still we expect that we will be able to slightly exceed the previous year, so that sales revenues will increase by about 5% over the previous year, and the operating profit and the return is to be 6.5 to 7.5%. Major challenges are the general economy, which has slightly slowed down, and the intensity of competition will certainly not decrease, and volatile exchange rate developments are probably a very realistic assumption, but there are also other challenges like WLTP and starts of production. So these are major issues we're going to focus on. On the return on capital, there will certainly be a result above our minimum rate, which we expect, a net cash flow, which is the KPI. What's certainly positive, net cash flow clearly above the previous year's level. And if then the payouts on diesel, which we will still have in 2019 and 2020, but if we adjust for this, our target of at least 9 billion on net cash flow, which can be achieved then. I can assure you that our sound liquidity policy will be continued without any qualification, and I'll be available for any questions that you may have after the second presentation by Herbert Diess. Let me now thank you for listening.
Thank you, Frank. The market environment remains challenging, but still, we are again setting ourselves very ambitious goals for 2019. As Frank Witter has just shown, we want to continue to grow profitably. Now, we're achieving this with 90-plus new models that we're rolling out this year in 2019. Obviously, we continue to grow the popular SUV segment. The share of the SUV segment in our overall unit sales has increased by 5% in 2018. And for 2019, we also expect solid growth. Highlights include the Volkswagen T-Cross, the Skoda Scala, and the Seat Tarraco. And, not to forget, we will be presenting the new Golf generation at the end of this year. So you see, model campaign is continuing at full pace throughout this year, but also we want to pick up speed with regard to transforming our company. 2019 will be therefore a key year for our group-wide electric push, with the first all-electric vehicles of the new generation going into production now at Audi, at Porsche, and also at the Volkswagen brand. Ladies and gentlemen, part of our DNA has been for many years to be able to mobilize people, to move them, and our brands meet a wide variety of expectations here. We are determined to make individual mobility possible for large numbers of people in the future as well. And when it comes to the volume segments, we want to make this mobility affordable. We also want to give people the freedom to move around wherever and whenever they want, without any restrictions or city driving bans. This is why we will now be gradually switching our entire vehicle portfolio to clean mobility. The Paris Climate Accord is the yardstick for our actions. Unless we significantly cut carbon emissions over the coming years, global warming will continue unchecked with devastating consequences. So therefore, we are totally committed to the target of keeping global warming below 2 degrees Celsius by 2050. Now, that can be achieved through a considerable reduction in carbon emissions across all the sectors of industry and society. Today, as we speak, around 14% of global carbon emissions stem from the transport sector, which also includes not only cars and trucks, but also airplanes and ships. The Volkswagen AG's passenger car brands alone, through the use of their vehicles, are responsible for 1% of global carbon emissions. Now, this 1%, we aim to reduce to zero. That is our goal, and that is our contribution to climate action. This is also why our Board of Management has agreed on a comprehensive decarbonization program. Our objective is to make the entire Volkswagen Group carbon neutral by 2050. And that, mind you, applies not only to our vehicles, but also to our own carbon footprint. So yes, this is ambitious, but we believe it's doable. CO2, therefore, will become one of the key performance metrics in our vehicle projects, but also in production and procurement. Now, 2050 is still some distance away, of course, and therefore we're setting ourselves binding interim objectives before that. So, for instance, by 2025, we intend to reduce the carbon footprint of our fleet over the entire life cycle by 30% compared to 2015. The global carbon emissions produced by our plants, we want to reduce by half compared to 2010. Now, all of that must not be just a vague declaration of intent, and therefore we're backing up all these targets with specific, with quantifiable measures. Now, here are the three principles. First of all, we want to make effective and truly sustainable cuts to carbon emissions. Number two, we want to switch renewable energy sources for power supply, switch to renewable energy sources. And third, we want to compensate for emissions wherever they cannot be avoided. When we reduce the carbon footprint of our vehicles, we are already starting with the supply chain. We aim to make carbon emissions a central aspect of the contracts with our suppliers. And already we've identified significant potential, especially with regards to batteries for e-cars or aluminium and steel. But also internally we are changing. We are converting our power station here in Wolfsburg, switching from coal to natural gas. That will cut carbon emissions annually by 1.5 million tons from 2023 onwards. And we're also switching to the use of renewable energies at our plants. Audi's production capacities, for instance, at the Brussels sites, come in at a completely carbon-free, carbon-neutral production. Now, to compensate for unavoidable carbon emissions wherever they crop up, we're planning large-scale investments in climate action projects. For instance, for reforestation and the protection of endangered woodlands. These measures, these compensation measures, will be paid out out of a newly created carbon fund with 50 million euros planned as a starting sum. Now, all in all, we're confident to say that this is the most ambitious and comprehensive climate action program ever undertaken in the automotive sector. Now, to reduce the carbon footprint of our fleet, and in complying with the strict EU requirements, the electric drivetrains will play, of course, a pivotal role. For the foreseeable future, e-mobility will remain the best and most efficient way of cutting carbon emissions in road traffic. Based on a mileage of 200,000 kilometers, an electric car throughout its life cycle uses around 400 watt-hours per kilometer, including manufacturing. So this means such a vehicle is able to operate much more economically than any other alternative drives. Using electricity in a drive system is 3 times as efficient as using synthetic fuels, as well as being significantly superior to the fuel cell, by the way. So in our view, there is no alternative to e-mobility over the next few decades. Ladies and gentlemen, what we are now starting here is a change of system. We must now focus all our energies on attaining that goal. A consistent focus is paramount. Openness to other technologies will not help us in our endeavors. It only serves to put off the change in system until further into the future. So, what is important now is that political and social forces must join up to focus on making the transformation to e-mobility in order to build up that very important critical mass and a vital infrastructure that it takes. Electric vehicles also need a swift energy transition, because in order to operate meaningfully, they need coal-free, they need carbon-free power. That is a must. And we call on industry, on politics, on society to now finally pull out all the stops and help e-mobility achieve a real breakthrough. This also includes a frank and an open debate about the consequences of e-mobility, because the reality is that building an electric car involves some 30% less effort or cost than one powered by an ICE, an internal combustion engine. That means we will need to make job cuts. And achieving this purely through fluctuation and partial retirement will be difficult. And this makes a good market position all the more important. So, what that means is the more successful we are with e-mobility as a company, the more long-term security this brings for our jobs. Ladies and gentlemen, there's no other traditional car manufacturer that is embarking on this new age with such a massive commitment as Volkswagen. In last November's planning session, we presented the most far-reaching electric campaign of our industry. And now, we're also adjusting our sales plans accordingly. By 2028, the group will be launching almost 70 new electric models instead of the previous figure of 50. The Audi E-Tron and the Porsche Taycan, these are the 2 vehicles that I already talked about. Now, shortly after these, we will be launching the ID, the first electric car selling for the price of a comparable Golf diesel car. And then this will be followed, among others, by the ID Cross, by the Seat Elborn, the Skoda Vision E, the ID Buzz, and the ID Vision. All of these are vehicles of our MEB family. Until 2023, we are going to invest over 30 billion euros to achieve this, and we thus further electrify our portfolio in all vehicle segments. But to make e-mobility affordable for as many people as possible, also what we need is large-scale production. We will therefore be using our new electric platforms to build, in the next 10 years, up to 22 million vehicles. By 2030, the electric-powered proportion of our fleet in Europe and China will rise to at least 40%. And in order to support this electric campaign, we have selected LG Chem, SKI, CATL, and Samsung as strategy battery cell suppliers. As a key component in any electric car, really, the battery is of major strategic importance to us, and that is also why we're now investing in the next generation of battery cells to make battery technology a permanent key area of expertise at Volkswagen. We have established a center of excellence based in Salzgitter. With a view to the increasing demand, we are also taking now a close look at a possible participation in battery cell manufacturing facilities in Europe of our own. This electric push is also changing the face of our manufacturing plants. By 2022, we will have set up 18 group-wide electric production locations on 3 continents. 8 of these plants will be manufacturing cars on the basis of the MEB, the Modular Electric Drive Toolkit. Our lead factory for the MEB will be the plant in Zwickau, where conversion now is in full swing. The first ID is scheduled to roll off the production line there at Zwickau later this year. The plants in Emden and Hanover will also be converted for production of electric vehicles from 2022 onwards. So these 3 sites will make up Europe's largest production network for electric vehicles. Now in China, with Anting and Foshan, also 2 MEB plants are currently under construction, and they will start production only a few months after Zwickau. In terms of North America, Chattanooga will be our site for the production of electric vehicles. But the Modular Electric Drive Toolkit, MEB for short, lies at the heart of our electric campaign. We aim to make the MEB a new standard for our industry. The MEB has been designed as an all-electric platform from the very beginning. It makes the optimal use of the latest technologies possible in terms of performance, in terms of space, but also in terms of digital technologies. The MEB enables driving ranges in excess of 550 kilometers in accordance with WLTP. It also has its own completely new onboard network. The VW OS operating system can receive updates over the air, so that turns the vehicle into a tablet on wheels. The areas of application for the MEB platform range from small city cars and large saloon cars through to electrically powered camper vans. It can also be used for small series vehicles like the ID Buggy. So the advantage is that the more cars that are manufactured using this platform, they also become cheaper. So that's why we're opening now the MEB to partners. This will result in economies of scale, it will increase our competitiveness, and it really brings e-mobility into the mainstream much more quickly. Just last week, in Geneva, we have announced our first partnership. Ego, with Professor Xu as CEO, will become the first third-party company to use our platform. And the first car to be produced on the MEB platform will be the ID. Tomorrow, you'll be hearing more from the brand board of management on this vehicle. So what I'd like to do today is to focus on one aspect. The ID will be launched as a carbon-neutral footprint vehicle, which makes it an important part of our decarbonization program that I mentioned a moment ago. A carbon footprint neutral vehicle obviously needs to encompass the entire vehicle supply chain, and this is exactly what we're doing with the ID. Our suppliers will exclusively use green electricity for the huge amounts of energies that they consume during battery cell production. For our car production at Zwickau, we use energy from renewable sources. To charge their vehicles, we offer our customers electricity that has been generated also in a climate-neutral way. And in the future, we'll be using recycled battery cells in our new mobile charging stations. And those, as I said before, those emissions that we cannot avoid at the moment, well, we're offsetting them by investing in climate action projects. Now, so at the same time, we take care of the necessary infrastructure, which is, of course, a critical factor for the durable success of e-mobility. In collaboration with our industry partners in the Ionity joint venture, we will be installing 400 fast charging stations along Europe's major roads and highways by 2020. 100 of those will be located in Germany, which gives you a charging opportunity every 120 kilometers with 400 or 800 volts fast charging up to 350 kilowatts. We have a new subsidiary, Elli, that offers wall boxes for charging at home, also using green power. We are then also setting up charging points on employee car parks and at the dealerships. The Volkswagen brand alone will be installing around 3,500 charging points for electric vehicles across its German plants. And we're also entering into partnerships with large retail chains. And this means customers will be able to charge their vehicles while they shop. Tesco's in the UK, for instance, will be our first such partner, and others will also then follow. Now, all of this shows how massively Volkswagen invests in electric mobility. But to achieve a real breakthrough, a number of prerequisites have to be right. In the coming years, infrastructure development must grow at the same rapid rate as the availability of new electric cars. Owners and tenants, for example, need to be given an official right to install their private vault boxes of their own. Towns and cities could, for instance, introduce useful incentives for purchasing e-cars by, for instance, providing special fast lanes on the roads, or more parking spaces, or more available charging points. And we also need a new tax system that would help us to limit climate change. There's no doubt customers are looking forward to the powerful, efficient electric cars, and obviously also the low costs of maintenance, running costs related to those vehicles. But they need certainty when it comes to the tax regime and the charging infrastructure. Now, that is a certainty that can only be provided by policymakers. And I sense that more and more people now are coming round to this way of thinking. I hope that we will not stop at discussions, but that this will lead to a pooling of energies. Let us stop criticizing, let us stop debating, let's shape that transformation together. Ladies and gentlemen, the great transformation to e-mobility is underway, and we have an excellent opportunity to gain a clear lead on our competitors thanks to our vehicles. And when it comes to the second great transformation, the digital connectivity and autonomous driving, we are also tackling the change with a similarly challenging, well, even radical plan. Namely, software. Software will play a vital role in cars of the future. It represents an ever greater portion of a vehicle's value. Software will account for 90% of future innovations in the car. Now, where we previously thought and worked in the 7-year cycles, which is a cycle traditional to the automotive industry, we would now need to think in periods of weeks, perhaps merely days, because our customers expect us to provide updates for our vehicles, services, across the entire life cycle of the vehicle. They expect us to be always ready to identify new needs and then respond to those needs and demands with our software. In other words, we have to add a software world, a software dimension to our vehicles. We have entered a world now that operates at a much faster clock rate than before. It's a fundamental paradigm shift. It's a real challenge, and the pace of that change is increasing all the time. Now, compare a car to a smartphone these days. A car has 10 times as many lines of code now, and a self-driving car will be probably 1,000 times as many. With a new Golf ramp-up, that has shown us that networking the various control units is currently much too complex. In the future, we'll be doing more under our own steam, and we're planning to take over suppliers that in the past have delivered software to us. The 70 control units from up to 200 different suppliers of the past, so to speak, will be merged into 3 central onboard computers, 3 or 4 in the car. And at the same time, we are the first traditional car makers that are organizationally separating the structure for hardware and software development. Christian Senger recently took charge of the digital car and services function at the Volkswagen brand, but also he has responsibility for group activities in this field. We are now developing VW OS, our own operating system for all of our future car services that is similar to iOS or Android, if you will. This means Our future business model will be more like that of a mobile phone company, because mobile phone companies' customers are loyal fans of the hardware, of the ecosystem. Their mobile phones are obviously a source of revenues for those companies, because they provide a system that can link to a number of different services. Now, with our new dealer contracts, every customer will have an individual ID from April 2020. That enables us to come into direct contact with our customers for the first time, and above all, through digital channels. These are fundamental changes in our business, and that's calls for entirely new skills, a dramatic realignment. Today, our 20,000 developers are 90% hardware-oriented. Now that will change radically by 2030. Software then will account for half of our development costs. We will be doing more of the work ourselves in future, and we're also planning to develop more expertise in software and car IT. Our focus also is on specialized training of our workforce as part of the new Faculty 73 program, our talent incubator for software developers. And we're also computing for the best minds, the greatest minds in the digital world, but that alone will not be enough yet. This is why we have also now started a collaboration with IT companies like Microsoft, like Wireless Car, like Diconium. Cooperation with Microsoft and the takeover of the other two companies give our technological expertise an enormous boost, and they will add another 1,500 software developers to our group, and we will continue our endeavors in that respect, in this field. So with this digital roadmap, we are addressing the topic within the core brand and also beyond the core brand. The Brand Board of Management will then be sharing with you a number of details on Wednesday. Ladies and gentlemen, the Volkswagen Group is now better prepared for the future than many would have thought possible. So, what we need now is to act more quickly and to address our deficits. And that is also why we're working hard on the further refinement of our Group's Together 2025 Plus strategy. We attach to it quantifiable targets, specific measures, and we pursue the aim of aligning our strategy with the rapidly accelerating speed of change. So, we want to become a stronger company for our employees, a more innovative company for our customers, and a better company for society. And last but not least, we want to be a more valuable company for our investors. Now, we will be addressing more details of that at one of our strategy days that we're planning to hold this summer. But there's one mission that's more relevant than ever before. In a world in which environmental protection is becoming important, increasingly important, in which social values are changing, Volkswagen is the watchword for a good future for individual mobility. I firmly believe that the car will remain the most important means of transport for people in tomorrow's world as well. It's cleaner, safer, and more comfortable than today. Thank you very much for your attention.
Ladies and gentlemen, these were the numbers and some fundamental remarks. At the beginning of his remarks, Herbert Diess said that Volkswagen will change fundamentally. This is why his remarks were a bit longer than usual, but we can now turn to your questions. Let me invite you to limit these question rounds to the questions of journalists, and we'll take the questions of investors and analysts in the meeting in the afternoon. So we could take until shortly after 11 for this Q&A now. Let me begin with Ed Taylor. On the outside in the second row. Good morning. I would like to ask the following. You said that some adjustments may be needed for Bentley in case of a harder Brexit. Could you explain this a bit more? And then you'd announced that the portfolio with its brands and assets will be reviewed again and again. Could you give us an update on this? And then the third question is, what about autonomous driving? Are you still in talks about this? And what's your trend about this? Are you going to work with a third party or with another OEM? Would you like to comment on Bentley? Mr. Bloom is responsible for the turnaround plan for Bentley. Of course, we could also ask about Brexit. You need a mic, I think. In the meantime, I could turn to the portfolio. Yes, indeed. We do review our brand portfolio again and again. All the brands are developing extremely positively at the moment. We are covering the most important needs worldwide. We have a pretty strong brand positioning, but of course we look at our brand portfolio again and again. But at present, there's nothing specific to report about this. Autonomous driving, of course, moves us. It's one of the major innovations coming, and in fact, it will mean radical change. And I think you've taken this from the press and from comments. The enthusiasm that prevailed a few months ago has cooled. Clearly, it's going to come, but at first I think we will go through a little valley of tears in this hype cycle. And it's a good position to get started on this and find the right partners. We're conducting talks, on the one hand with Ford. We have also had talks with some other German manufacturers. We're positioning ourselves, and I think we're at an equal footing with many competitors. And we'll certainly make more decisions on this in this year. And I think partnerships will be very important on this, because the spending, the cost, is in a high single-digit range of billions before the first autonomous cars will be driving on the roads. It also means certain acceptance issues, and we also need to conserve resources. So it's a good thing to work together with partners. Oliver, now on Bentley. Well, concerning your question on Bentley, Frank Wetter pointed it out. Bentley had a difficult year. This was due to the SOP of the Continental and due to WLTP issues and to some cleanup. We have a new board of management team at Bentley with a comprehensive turnaround plan, which now has first successes to show for. For the first quarter of this year, we expect a positive result. And we have prepared well for Brexit. This includes all customs handling issues. This includes all the logistics issues associated to this. Also, when we look at the import of material and the export of vehicles, we have studied various scenarios, and as soon as Brexit comes, we will compensate for various issues as far as possible. What we can't compensate completely on the pricing side is if tariffs will in fact be charged, and we will see before the end of the year what the scenario will be like. The next question comes from Mr. Rauwald. He's in the second row. Could you have a microphone, please? Good morning. My name is Christoph Rauwald of Bloomberg. Mr. Witte, you had pointed out that the cost for WLTP amounted to about 1 billion, but now we've read it could have been up to 3 billion. Could you give us a specific number on this? And the second question is on self-driving technologies. Last year we read that you're thinking about acquiring a share in Waymo up to 10%. Is this still up to date? And thirdly and finally, this issue of headcount reduction was mentioned by you, Mr. Diess, and that it could be difficult to bring this about, this technological change, in a socially acceptable way. Could this also affect current agreements on certain plants, and might you even have to think about compulsory redundancies? Let's begin with WLTP. I think it is necessary to say a few more things. I want to avoid giving you some numbers, but first of all, the dimension and the implications of WLTP. We had additional shifts, we had closed days, we had additional logistics capacities. For some time, we made valuable use of the Berlin airport. Just think of the impact on suppliers, just think of the impact on customers waiting for their cars, to give an idea of the dimension of what happened in the operating business. So before I get to numbers, I would first of all like to thank all our customers and all people involved at dealerships and at the plants that they kept their nerve. This was nothing to be taken for granted when you look at the second half of the year. I told investors again and again we're talking about 1 billion. When, if it were the 3.5 that have been bandied about, I would throw a big party, because if you take the 17 billion and add the 3.5 billion, then we would have had a sensational year adjusted for WLTP. But in fact, it was the 1 billion that came as a charge, and there were two major drivers. One is that volume was lost, which we otherwise would have made, but there was also a need for sales aid, which was considerably higher. If customers are not getting what they expect, you need to sweeten the deal somewhat for them. So this explains the numbers. You also looked at what it means for 2019. There will be a second WLTP Act. This is known. There will be EVAP. This is emissions. And there will be real driving emissions, RDE. And I think there will be a certain impact, but it will be clearly lower in 2019 than what we experienced in 2018. And the financial charges will also be lower in line with this, but it would be naive now to roll 2018 over in 2019. In fact, there will be some negative impact on one or the other brand in 2019. The whole tendency is somewhat biased to the right, but we have done a lot. We have additional testing capacity. We have prepared well. We are better prepared now, but WLTP and all the other issues mentioned will have their impact. But 1 billion is still a good number.
When it comes to questions on Waymo, we've never planned to take a 10% stake in Waymo. Maybe there was some incorrect news that you heard there. So we are obviously one of the great technological car makers, of course, and our objective is to drive autonomously under our own steam, as it were, with the direct access to code with our own IP. In other words, we've never considered to take a minority stake in an SDS operator, self-driving systems. Now, I think we're looking into that with our colleagues from Ford on an equal footing, and obviously they're also competing with other OEMs there. But we see good opportunities in the next months for a participation and also a significant contribution. But 10% Waymo, that was never a debate, never a discussion. Staff cuts and discussions we're currently leading are predominantly related to administration, where we will also see more digital technologies in the next months to come. I can refer you to the event planned for tomorrow, i.e. the press conference on the Volkswagen brand. Compulsory redundancies are not under discussion. Now, any adjustments and structural change requirements can only be solved together with labor representatives, and talks are ongoing, but we will not see compulsory redundancies. Let me add in that context, it's very important to address that structural change early on, in order also to use the demographic changes, demographic developments. Now, take the question of how we are going to control our global components business. That is very much in line with that. Or our discussions, and not only here in Wolfsburg, on the Pact for the Future, with other brands as well. So brace up for the challenge early on, and this is what we're going to do going forward. Okay, we need the mic now in the second row, Ms. Janssen. Good morning. Just talked about the Works Council. The Group Works Council complains about mismanagement and difficulties in development. So my first question, is Mr. Osterler right with what he's saying? And my second question, will there be consequences in terms of people and staff? Well, for sure, WLTP and the way we dealt with it was not the way you should have done it, not optimal. A number of facts or problems related to that. People were still very much working to rectify the diesel situation, and they were overtaxed in many ways. We were not prepared well enough. Now look at the complexity in our drivetrain portfolio was probably just too much to handle that promptly compared to what other OEMs have been doing. So yes, adjustments have been made, then new organizational structures, we've created new capacities. Could that have been done better? Of course it could. I'm sure if we had been focused earlier on, we probably would have done it better. As far as consequences in terms of staffing is concerned, well, I wouldn't say that, but we want to boost operating performance in development, and therefore at Volkswagen we are going to see Mr. Rabe from SEAT, a very experienced engineer who is going to boost the operational strength to help Mr. Welsch in our organization. We're going to separate, as I said, software and hardware. Mr. Sanger will be playing an important role at Audi. We have a new head of development who is very, I think, systematic in his approach, because Audi obviously has seen a change on the level of the leadership team. So I think the staffing changes now that have been taken, they are finalized. And then we have a question from a Chinese journalist, Mr. Peng Ji, in row number 4, please.
Yes, hello, Dr. Diess, 2 questions. The first one is very simple. How much will China account for the 22 million production plan for the electric vehicles? And second, if I can summarize the 3 key words since you've become Group CEO, it's China, it's software, and it's electromobility. So your future will be determined on China, your future will be determined on software, and your future will be determined on electromobility. So the question is, what is the link among those 3 keywords? Thank you.
Indeed, you're touching on very important terms that I think will place us in a very good competitive situation. We have a large market share in China. We're very profitable in China, as Mr. Witter has said. We have an 18% market share in China. And China perhaps is the pioneering market also for e-mobility, where we now have the highest sales numbers, most pronounced growth. The political agenda for e-mobility has been taken now. Infrastructure is currently under development. In China, truly, there is a commitment for e-mobility. We believe China will be developing rapidly for the electric market. We believe this is an opportunity, a good chance for Volkswagen to develop economies of scale. Now, I mean, we'll see over time, but 40 to 45% of our sales volume is in China in the first years of e-mobility. That will create a solid volume foundation to also be competitors in the rest of the world with our MEB platform. So yes, then you're also mentioning software. Software also is something that we believe we have to be innovators. We also see that China has an innovative industry when it comes to software, and also the large technology companies that are currently still in the US and the West Coast have been mirrored in China, but they have built them up in their own country, and we'd also see what's happening there, and we are also called upon developing local solutions in the Chinese market, software and connectivity. There's actually a government program in place also on connectivity and autonomous driving. That, for us, I think, is an advantage. Yes, we have a good footprint, we have a powerful R&D function that we want to extend also in China, and actually, you're boiling it down to what is really mattering. We see a strong focus on China. E-mobility plus software will allow us to be even more successful globally. Okay, next question goes to Mr. Vetter, please, in the back of the room.
Good morning. My name is Philipp Vetter of Die Welt. I would like to ask you 2 or 3 things. First of all, you quite clearly now stated that you want to go for battery electric vehicles. There are other voices, especially within the VDA Association. Would you like your colleagues to also make a clearer decision? And also, what does it mean for you within the group? What does it mean for other development projects like fuel cells and synthetic fuels? Will these be discontinued for more focusing? Then you also wanted more clarity for the tax situation. So would you be interested in abolishing any tax breaks for diesel fuels? And then finally, your relationship with Mr. Osolo. This seemed to have been difficult over the last few days. Has this sort of cleared up again? Well, I think I said in my speech, we now need to make a decision. We can't discuss about technological openness anymore. This won't help. We need a change in system. This won't come from customers. It won't come from the car industry. It will only happen if society wants it. Chinese society decided quite clearly they want this system change. They back electrical mobility. It's going to come. We still seem to be a bit more changeable, at least in our public discussion, and I feel that this time should now be over. The facts are quite clear, and the climate targets can only be attained with electric vehicles, well, synthetic fuels. These are all interesting innovations that should be pursued, but they will not take any effect within the next 5 to 10 years. We need an effect in the short term. We're not giving up these technologies. Fuel cells do make sense. Just think of this large surplus of renewable energy production that we have whenever there is wind and there is sunlight. And there's the problem of storage. Then you can't store everything away in cars. And once we have reached that level that renewable energies are overflowing, this is the point in time then for converting this energy into hydrogen. But you've seen in the charts it's less efficient. For the same distance traveled by a car, it takes 3 times as many windmills, or 2.5 times as many, than using this electricity directly for charging a battery. So let me clearly appeal to our colleagues as well, focus on electrical and also on expanding the infrastructure. The fuel cell will certainly be pursued further. Audi is working on this, and it makes a lot of sense in transport as well. Tax clarity, well, here I would simply like to make a suggestion. The thing is, today, of course, customers are extremely dependent on the tax regime in their markets with their prioritization of cars. In Europe, we still have a diesel share of 70 to 80% in some countries. There are markets in Europe where there is a share of 5%. There are worldwide markets with a gas share of 70%, or there may also be differences that are regional. There are some countries where there are no cars above 1.6 liters, simply for tax reasons. So the tax regimes influence customers' behavior very much. And I think for environmental reasons, we need to ask then, do we have the right tax regimes in order to support carbon neutrality? That's the question I'm posing. I won't discuss what's more expensive or what should be cheaper, but let me point out one thing which is curious. On the petrol price, on the gasoline price, this includes a tax for vehicles, and this amounts to 350 euros of tax on CO2. You know, we are discussing carbon taxes of around 50 euros per ton, but for the car it's already 350, around 350. At the same time, we're incentivizing carbon emissions with 1 billion of coal subsidies. So the production of a coal ton of carbon is subsidized at 100 euros per ton from the same tax coffers. So it's really worthwhile thinking about this if we want to stop climate change. Finally, Mr. Oselo, well, I think we had a very constructive meeting yesterday. Do bear with us. We're undergoing major, dramatic change. We're bringing about a lot of change at our plants. This leads to a lot of insecurity among our people and among the Works Council as well. We're talking about headcount reduction, not headcount increases. So I quite understand this, that we have to discuss things, that positions may be hardened, but we will resolve these things. Two more things on tax clarity. It's not just about Germany, but about the European context as well. This has to do with the fleet business, with company car taxation, and also then taxation on the free electricity you may get. Mr. Baumeister, and then Mr. Foucault in the first row. Baumeister of Plato Brief. I would like to ask you a question concerning China. Chinese leaders announced that foreign parties can also take over majority shares. This may be something that might be interesting to you. What is the current status? What are your intentions? And what impact would this have if you had a majority share? What impact would this have on the recognition of the Chinese joint ventures in your balance sheet? It would no longer be covered at equity, but it would be reflected in the operating profit. Then it would be much nicer and much clearer. Thanks for pointing this out, this possible value improvement. In fact, it's our task to reorganize our Chinese interests in the next 2 years. We have a new joint venture, JASC, and our commitment is to start along with SEAT, and then our truck strategy in China also needs to be rethought. So these are quite a few issues, and this also includes the question about the majorities. Some competitors have been able to achieve something here, and the Chinese leaders are opening up towards this issue. So we will be working on this during this year, and hopefully by the end of the year or beginning of next year, we will come back with some answers. I think it's a very good environment for conducting these discussions now. And on the other hand, as you mentioned, our interests in China are very valuable. So it's not that cheap if you were to take over a majority share. Let me add, if I may, we have wholly owned subsidiaries in component production, and it's very gratifying to have them when you look at their operating profits in the existing joint ventures. The question is whether you have the majority and control. This would change the way in which they're recognized, but this is no issue at the moment. But I won't keep it from you that it would be nice if the 4.6 billion were reflected in the operating profit. At the moment, the situation, though, is the way it is, and Herbert Diess has just explained the strategic aspects. The next question now from Mr. Foucault in the first row, and then the next question will come from Mr. Engemann.
Thank you. Mr. Diess, you mentioned that radical change was not easy. So in order to build 22 million electric vehicles in 2028 profitably, so how many people in plants do you need to reduce?
Sorry, once again, how difficult do you...
How many people in plants do you need to reduce?
Do we have to reduce? I think we have an agreed reduction plan in our Hanover facilities and at the Emden facility. This would total up to between the two plants between 7,000 and 8,000 people until 2023 or 24, which we still can manage under the was heißt unter dem demografischen
riding the demographic curve.
In the demographic curve. Ja.
Mr. Rengemann is next. Second row, please. Thank you very much. Marco Engermann, EPAFX. Mr. Witter, can you briefly talk about WLTP and tell us how many vehicles that you had to sell off with a discount, or can you not sell? How many you have been discounted or discounting to buyers? And Mr. Diess, a question on autonomous driving. You're saying you're talking to Ford, but what is there between you, the two of you? Is it technologies? Is it strategies? Is it about money that has not been clarified yet? And another question on Waymo. Has Waymo requested you for a stake? Thank you. Okay. Now, I'm not sure I understood your question correctly. Now, there was a temporary problem where we had up to 200,000 vehicles that had to be stocked, but vehicles were added to those stocks and others were removed from those stocks. So it was an ongoing process of banking. Now, is this what your question was about? I'm not sure whether I've been hitting the nail on the head here. Could you follow up and say what exactly we're talking about? Now, the question was, what were the incentives paid? Well, can you say, how much cars did you sell with a discount? Well, I don't know. And you can't say that. Now, with any euro that comes in, it doesn't say where it comes from. We're looking at a combination of different factors. We know, of course, how many vehicles were sold off under certain programs like the eco scrappage premium and how incentives have been paid. But obviously, we're facing a situation, as I said before, there have been a number of vehicles that were offered as a product portfolio, and customers wanted to reconfigure their vehicles, and if they can't get the configuration they wanted, you have to make some proposals there. There's also fleet transactions. So the main factors here are vehicles lost and additional incentives. Now, the truth of the matter is no one can tell you the exact answer to the final euro and cent. I've been talking about the gross numbers of risk, which is above 3 billion. Which is a number that we work against to reduce it. Obviously, you don't only look what you're lacking in your portfolio, but also what you have in your portfolio in order to sell it to customers. And our salespeople have been doing a great job. And obviously, 1 billion euros obviously is a dramatic backlog that we're not selling here. But again, it's not possible to break it down onto each individual car and the discount with which it has been sold. We have a good understanding of the general picture, but there's so many processes throughout the year that are not necessarily related to WLTP. There's competitors taking a campaign, you have to respond in terms of dealer rates. So there are many other things that we have been doing. But that 1 billion euros that I mentioned before hits the nail on the head, I think. Coming back to the question of autonomous driving. In the past 7 or 8 months, we have been systematically looking at the competitive landscape and also wanted to understand what we should do. For us, this is a key competence that we want to develop, and we do have resources. We already have established partnerships in that area. And in the last 6 or 7 months, we have reanalyzed that with many partners, not all partners we have been meeting with, including also Waymo. Waymo, of course, as we speak today, is a leader, still a leader. But about a half year ago, we realized that the euphoria is waning a bit on self-driving systems. And it is impressive, I must admit that, to sit in a car and drive around like that. Without a steering wheel, you're being picked up by a car, you get on, and then off you go. We have cars like those as well. But that is not the question. What is the question is how, and it works up to 90% or 95%, namely, how do you do it right and safely? How can we get government approval? How can we actually prove that under all conditions you operate a safe and secure system? We learned a lot in that process. Audi has been a pioneer in those past years when it comes to SDS. But we then realize the safety you need in order to offer such a system to your customer is not something we can achieve at 100%. And it turns out that it probably will take even longer than we may have thought a year ago or 2 years ago. So again, yes, we will be refocusing ourselves. We have taken some fundamental decisions already. So robo-taxis, for instance, is something that our commercial vehicle subsidiary is taking care of. We're building cars now with a view to that, like the ID bus that will have sensors, redundant steering systems. We beefed up our personnel capacities now that we have with engineering experts. So yes, I think we're in good shape, and we're in good talks with Ford. But again, this is not going to happen this week. It's unlikely that we're going to finalize this week. Mr. Gagliano, microphone is near to where you are. Mr. Gagliano. So you have to move back a bit. Christoph.
Yes, good morning. A couple of questions. You said that by the year 2022, you will have 18 factories on 3 continents that will produce electric vehicles. I don't see any plant in Spain, in Martorell. So I was wondering if in the future, since SEAT has announced a new hybrid vehicle, the plant in Spain could contribute to this new strategy. And the second question is, if you have, as a group, some figures on sales of diesel vehicles, because I guess these last year there have been probably a decline. Thanks.
First question, maybe you first on manufacturing locations, and maybe then Bram Scott can say a few words on diesel. Our electrification strategy is applied top-down. We believe this is a meaningful approach. We start with the premium brands, Audi, then comes Porsche, and then we go down to the A segment, so the Golf segment. And then we'll stay well above that, SUVs and saloon cars. Why? These are segments where we believe in the foreseeable future, in other words, in the next 5 years, we're going to see a situation that such electric cars will be comparable to internal combustion engines in terms of efficiency. So internal combustion engines will be more expensive, and then in the future we can reach out to other segments like the Golf as well. But we need to think beyond that. So we will see e-vehicles in the Polo class. Now that's much more difficult. Batteries remain expensive, so the price difference between a conventional car and an electric car in that class, like the Polo or the Up, is a bit of a challenge when it comes to the economics. Well, SEAT is working towards that, of course, but SEAT believes that first of all the production will start in China, and then further decisions have not been taken as we speak. Now, if you continue to think about what we want to do, i.e. go up to 40% by 2030 e-mobility share, then obviously we have to electrify those lower segments as well. And there will be that one day when in Spain we're going to develop the first e-car factories. Bram Scott on diesel. Now we're talking about 58 to 60%, is down to below 50% or 45%. In small cars, the diesel rate is only 7, 8, 9, 10. Larger cars, diesel share is a bit higher. Now our assessment for 2019 is we're heading for 45% of diesel share, roughly. Okay, can you pass the mic back by one row? There's a colleague. No, just a minute. I'd like to add something here. Now, what's quite remarkable in the current discussions is that in some brands in the past months, especially in the fourth quarter of 2018, we have seen a rising share of diesel cars again. Why? Because markets have responded differently. Nothing happened in Italy. In Italy, the diesel share remained on a rather high level. In individual markets, including Germany, with the discussion on city driving bans, or in the UK, the diesel share has been going down. But we see a notable stabilization now. And as Bram has said, it depends on the individual vehicle segment. Now, when I talk about stabilization, people think about residuals. Well, we are seeing a reasonably stable situation when it comes to residual values, and we've also adjusted the residuals for diesel cars, which means for me, as a finance expert, I'm not seeing things that keep me awake at night.
Hi there, John McElroy from Auto Express in the UK. You've mentioned the licensing of MEB technology today with Ego and your discussions with Ford. Is that the total, or can you confirm if you're in active discussions with other OEMs about access to MEB? And would you consider deals even when the products they produce are rivals for your own brands? And could you also include manufacturing capacity for other OEMs in your factories?
Generally, we are open. There are a few more requests already. We are strong in China, you can imagine. Also, this would open up for smaller manufacturers to really become relevant. We are open. Manufacturing is to be, let's say, considered. Ford is one of our rivals here in Europe, so if we license the platform to Ford, or if Ford would use that platform, we would be prepared also to help those colleagues. I wouldn't say that we would invest for a plant, for a manufacturing plant, but if we would have spare capacity somewhere, that is for sure an option. If it makes economically sense, it's an option.
So, dann wäre der Herr Schmidt.
Next, Mr. Schmidt, and then Mr. Pretzlaff. Mr. Schmidt in the middle, by the window. Just three short questions, two for Mr. Witter. You spoke of investment in e-mobility, which increased in 2018. Maybe you could give us a number, how much this amounted to, and what we expect for 2019. I suppose it won't decrease. The second question, reducing complexity. Last year, you launched 70 new models, this year 90. This doesn't sound so much like reduction. What will this be like in the years to come? Or did you not count e-mobility here so that the number of models still remains the same? You have the 25% target for Volkswagen and the 30% target for Audi. Maybe you could give us an indication over what period of time this is to come. And the next question then, for carbon targets, you gave us 2015 as the basis for cars and 2010 for the plants, but you took these as the baselines. Why did you choose these baselines? Dr. Diess, could you begin, and we will hear Oliver Blume then on the plants and the carbon figures. Complexity reduction. Well, let me begin with the question on investment in e-mobility. In 2018, when you think of capital investment, all in all, it was a share of about 3%, and in 2019, this is about to nearly double. So, in fact, this is a topic on which we are spending more and more, and complexity, well, it feels like a contradiction, because in addition to combustion engines, we have now the electrical world, and we shouldn't forget our push on hybrids, especially plug-in hybrids. So it's even more important that we come with good management and group-wide management. So when we embark on electrical mobility, we need to consider the positioning of our brands so that we have good efficiency, and wherever possible, we follow along the lines that we have taken on combustion engines, that is, reducing the number of engine and transmission versions. Electrification looks like a step back on this, but there is no alternative. There are also the fleet targets to keep in mind. So financial discipline is extremely important and is required, and each brand has launched its own programs to support this, and these will also be presented. Let me add, concerning the Volkswagen brand, it's quite tangible. Volkswagen gave up the Phaeton, the Scirocco, the EOS, the Beetle convertible. A few things are still under discussion. The Golf convertible has been given up. So we've clearly streamlined the portfolio. Some models are being added, electrical models that we didn't have before, but some electrical models will directly replace their conventional predecessors. It will be an exciting task to manage the portfolio. When you look at drivetrains, of course, also with the support of WLTP, we clearly reduce the number of engines. Group-wide, this is 25 to 30%. The new Golf has about 30% less complexity on its launch, and it's the same for Audi with many of its new models. In the electrical world, we will be able to manage complexity better. Basically, there are not so many different drivetrain versions. There are different battery sizes, 2 or 3 performance sizes, which are often controlled by software alone. So complexity will be reduced in the electrical world by at least 60 to 70% compared to today. So this will give us some headroom, and we're very, very consistent in introducing our platforms. I think other manufacturers are facing the same problem, but I think we're doing pretty well on it. Let me add on the investments on electrical mobility. This is mainly capital expenditure, but it's also spending on research and development. And by 2023, we expect that we're spending about 30 billion on electrical mobility. This is a clear commitment, but there is no alternative. When you look at the major regions of the world where we need to attain carbon targets and also meet customer needs, and we're quite optimistic about this. I think our products, and you will have an opportunity, a select group will have an opportunity to experience this tonight. These products certainly give reason for enthusiasm. We could certainly hear something about the Taycan and the E-Tron here. There is great customer enthusiasm, and so our targets are not unrealistic. The Golf SOP, 30% less complexity means that certain engine and transmission versions are no longer used. And this brings us to carbon at the production plants. Well, first of all, environmental indicators in production, we have set quite rigid targets up to 2025 so that we reduce environmental emissions by 45%. Energy, water, waste, and solvents will be influenced by this. We've made major progress over the last few years concerning carbon reductions. Here we expect clear improvements, especially based on what Herbert Diess has just said, like Brussels, which is carbon neutral, and we're making the first purely electric Audi there, and at Tuffenhausen, when Taycan starts production, the same at Zwickau, that we have carbon neutral production there. We have 3 priorities. First of all, avoiding carbon emissions. Secondly, reduction. And thirdly, compensation. Quite a few things will come. To explain why Oliver Blume is talking about this, on the group board of management, he's responsible for production. Let's now hear Mr. Pretzlaff. He's in the 4th row, and a microphone is coming. Harry Pretzlaff of Stuttgarter Zeitung, Stuttgarter Nachrichten. I haven't quite understood the employment development because of electrical mobility. If you make 22 million electrical cars within the next 10 years, how much additional headcount reduction is needed then beyond what has already been agreed, and how are you going to achieve this? And then concerning China, you said the future is decided in China. Now with the new Jetta brand going into the cheap segment, there is particularly higher competitive pressure there. Do you think you can achieve viable prices there? And then there are many new competitors like Neurobauten on electrical mobility in China. What impact do you expect from them? Do you think that many will not even make it? They all have ambitious targets. What's your assessment? Well, the employment development, we're reviewing this every year with our planning. the electrical numbers are increasing under the present planning, and this reduces employment, but the impact will not be that dramatic. We have time for this structural change. For 2025, we expect about 15% electrical cars, 15 to 20% for Europe. It may be a bit quicker, but not that much quicker, because we also need the batteries for this. So it will be within this range, and it will still be 80% conventional cars. So the cars, the plants impacted are not so many. But there will also be productivity improvements because of digitalization. But so far, we have been able to manage this structural change along with employee representatives. We're not just ignoring it or waiting and seeing. We're taking action early on in our training profiles, in the employment of young people, and in our programs. Now, we don't have Mr. Kilian here, unfortunately, but his assessment is that the structural change is manageable if we address it early on, and we are addressing it early on. China with the Jetta brand, yes. We had this long discussion whether Volkswagen should go into economy segments. When you think back, we had discussion 3 years ago in China, and quite rightly, because the local brands grew very rapidly in China, and they also took away market share from us. You know these brands, local manufacturers like Haval, they've become very competent and have come with very strong models. On the other hand, we saw this trend in China. We have this long tradition, the Chinese entry-level engine for the Jetta in the north and the Santana in the south. These are cars that are seen like the Beetle here in the West. They have really started mobilization in China. And we saw that the Volkswagen brand, as we were very aggressive in our pricing at the lower level of the market, still profitable, but very aggressive, we thought that it will probably make more sense to protect the Volkswagen brand in the higher levels. After all, we're offering premium cars like the Touareg, and to redefine the entry segment. And I think this idea of doing it with the Jetta has advantages compared to a new brand. Jetta is a really well-known brand name in China, different from here. Many associate very positive experiences with it. So this approach will help us use our own sales network, but we can open up a second, more aggressive pricing line. And I think looking back, this has done us quite good, because this also means focus on cost in a competitive segment like this. And this has done us quite a bit of good. We're going there with our most advanced platforms. It's all based on the MQB. So this focus on cost has done us good. It will, in fact, improve our overall competitiveness in China. So we'll have to wait and see whether it works out. But we're quite optimistic the cars will be good, and even at lower cost, we can still achieve good margins. New competitors, yes, there's a lot going on, especially in China. You can read a lot in the press. And of course, there is this radical change in the car industry. You don't need engine competence anymore. You may even be able to buy a platform. So this is an opportunity for starting new brands. Some will come through. Billions are spent on this. But you also see it's not that simple. Tesla has become very competent, but still entering our market is really a program that takes billions, not just 1 or 2. It may be 10 or 20. And not everybody has this kind of money. And not everybody will make it. So there will be new competitors, and I admit they may be faster in one or the other point, or maybe better connected, but we're still doing very well.
Now we have Mr. Wenzel, Mr. Hapke, Michael Dean, Ms. Meyer, and Johan Ferrari. But then, unfortunately, I'd have to close the speakers list here. And may I then ask you also to be very brief in the questions that you're going to ask now, because we want to make sure that we can take as many questions as we can. Now, Mr. Hetzner is first here. He is in the first row, please. Thank you. I have two questions. About China, you said the future of Volkswagen hinges on China. Now, how do you assume your new task as group head for China? Can you explain to us the advantage of, a situation when the group does not have an individual group representative or board representative in the country itself in those difficult times? So what does that mean? And then secondly, when it comes to e-mobility and software, you talked about staff cuts and production, but you're also saying that half of your development budgets will be changed over to software development until 2030. Now, what does that mean for those 20,000 engineers? Does that mean also that they have to face or to fear staff cuts in vehicle development? Now, when it comes to China, and I think we've addressed it a number of times here, we see strategic need for action in China. China will be playing an entirely different role than hitherto. Now, we see now technology in China that we have developed in Wolfsburg and at Audi in Ingolstadt, but produced locally and marketed locally as well. Drivetrains that have been adapted also, and the design obviously also has been slightly adapted to the Chinese market. But that will change. It will change because China now is a player on an equal footing when it comes to connectivity and digital services. We believe that China, in some areas of the automotive development, will be assuming a leading role and can assume a leading role. Why? Because it's a huge market, it continues to grow, has a growth potential. The Chinese are very innovation-friendly. They embrace innovation happily. Now, they have been taking the lead in mobile communication system, in payment systems, as we heard this morning. And in Europe, we are obviously characterized by the big technology corporations that can also foster a new development in other parts of the world. Now, obviously, in China, there are internet companies, search engines, so many tech savvy companies that also have been playing and will be playing an important role in the car market. We cannot assume at the moment that we do business as usual as in the past decades. In other words, develop technologies in Europe and market them and sell them in China. It's not going to work. With a new ecosystem, with the new political conditions there, this will no longer be required. Now, the decision in terms of how to organize ourselves, those decisions will be taken now, 2019, 2020. And again, these are not local decisions to be taken in an individual market, because these are overarching decisions for Audi, for commercial vehicles. So all of our group brands have to engage in that dialogue and take the decision from here. So I think it's the right decision now to look at the organizational setup of the group in the next year or two with a strong focus on individual brands and what those brands want. And then we have to sort it all together and see how it falls into place. Also, that is important for our joint ventures, our future technologies, autonomous driving, what are our technology partners going forward. And because it is so important, you cannot operate businesses individually, locally in every part of the world. It may change in the future, yes, but I think strategically now as we speak, we have to reorganize ourselves here in order to embrace the future. That is important. Now, secondly, you asked about software. Yes, this change is ongoing. I should add, though, that today we hardly have any software competence in-house. We purchase a lot of software that's already in the control units. Obviously, we have good competence in connecting different bus systems and control units and to make sure that the software works. Different types of software work in our vehicles, but also that will change. In the future, we'll have our own software stack that is developed by ourselves centrally here, based on the group level, and obviously there will be a number of core components that will then be used by our subsidiaries, by the brands. Gives us economies of scale. So yes, this change is a reality. But when it comes to 2030, we will still individual brand designs or add-ons, a differentiation between sportier or less sporty cars, a lot of hardware differentiation. I will not assume, therefore, that we will have to make cuts in that respect. But the software components will be much more important. We need to develop more software competence. And the startup companies that you've just mentioned, all the competitors at the US West Coast, already today account for that 50% split. They have 50% software, 50% hardware engineers, and we need to be heading there as well. Okay, next one.
Hi, Dr. Diess. A quick question. A year ago, you said you reiterated the goal of 5% market share in North America. Can you get to that number with electric vehicles in the remaining 9 years of that goal? And secondly, how will Volkswagen offset the management use of private aircraft, which are very carbon-intensive vehicles, and will you get rid of your, do you plan to get rid of your, or limit your private aircraft fleet?
Private aircraft, our current fleet, or was? Corporate fleet.
Soll ich da?
Yeah. To come back to you end of the first quarter, because we have a new team in place. I think they're working really hard to improve our US strategy. We have been growing over the last years. The brand was recovering. The new products are successful. We are becoming more and more a SUV brand. Tiguan is working well. Atlas is working well. Now a 5-seater will come, so we will increase our portfolio. I would say we are also considering one or the other product from the Ford partnership. So there's a plan to be worked out. We stick to the strategy that we have to become relevant as a volume player in the United States, which means a market share of at least 5%. So far, we didn't pronounce when. It's for sure a long way to go, but we won't give up. I think the team is really motivated and good underway. And I would say end of first quarter, we would come back to you with a new, refined plan for the Americas.
Yeah. Just to add on that side, we shouldn't forget that, yes, we have our issues with Volkswagen Passenger Cars in North America, but we also have Porsche and Audi who are doing extremely well and are very successful in North America. But Volkswagen Pass is obviously to be refined. With respect to corporate fleet, yes, we do have a corporate fleet of aircraft. I think if you have this type of global footprint and the amount of work which we need to accomplish, I think for the time being it is unavoidable that we operate corporate aircraft, but we are certainly paying attention to CO2 and other measures, costs as well, and therefore we are optimizing the composition, particularly for the shorter distances and donation here in Europe. But for the time being, it is the only way to do what we are requested to do, but we optimize the fleet.
May I add? You know, when we started this CO2 discussion, now it also becomes relevant, how's your footprint? Yeah? So what about you? And the private aircraft fleet is a big contributor. Now, just my figures, now, and it's bit dangerous to announce it, but you know the average European has CO2 emissions of between 7 and 8 tons. In the north, more than in the south. South is probably below 5 or so. So I have 1,300. Yeah, and this has to do with using the corporate fleet a lot. So I have to travel forward and backward to China, US. But my commitment is to at least try to reduce it by 20%. Using more, it's not public transport, it's general, normal business aviation. Business aviation. Yeah. So it's something to consider in the new world. Yeah.
So, die nächste Frage.
Next question goes to Mr. Menzel, second row, please. And then Ms. Meyer in the back and Mr. Hapke. Stefan Menzel from Handelsblatt. Mr. Diess, do you think you are promising too much when it comes to e-mobility? So you're talking about 22 million vehicles, but you have software problems now with the Golf Mark 8. Now then from Zwickau, we're hearing that something is not going quite so well, some glitches there. Now, maybe your model policy doesn't work out the way you think. So do you have a handle on that process? Aren't you promising too much? Because WLTP was a case in point, something you underestimated. So shouldn't you be more careful when it comes to targets for e-mobility? Okay, that's a valid point to make. Our transformation plan that we are embarking on is extremely ambitious. And it's true that we have a number of areas needing improvement. Audi, strategic questions. We're still facing a crisis situation in some markets. It's an extremely ambitious program. But having said that, Volkswagen has a powerful team, has a lot of expertise. And if we manage to mobilize them, I think we're standing a good chance to get it done. Strategically speaking, I think we're in much better shape than many of our competitors. But of course, it's going to be quite a tall order. And I'm sure that some things will not work out. But still, there is no alternative to that. We have an aggressive transformation plan that is a must.
Right, Ms. Meyer is next then. Bettina Meyer of Automotive Sport. My first question is, on PPE, do you categorically rule out partnership, or are you already looking for partners sharing the platform with you? And the second question, the Jetta in China is based on the MQB, the new low-budget car in China as well. Is there any connection between these two projects? No, Ms. Meyer, the Jetta is our entry segment, and there is no alternative. This is MQB, and it was a difficult discussion we had. I think, looking back, it was right, because this gives us an extremely modern car, and it will certainly be successful against competitors. This leads to economies of scale for the new platform, not on a PPE platform that's being phased out. Mr. Oslo, Mr. Welch also were very much committed to this discussion. And when we discussed the Jetta and the MQB, I think we were doing a good thing. On PPE, we are not thinking about this. This is really about the volume platform, where scale is even more important on the PPE. We have great differentiation. There is 800 volts. There are different transmissions. So PPE is not on the program at the moment. Thank you very much. Ms. Slavik needs the microphone then, and then Mr. Hapke. Lucky, I thought you'd overlooked me. I have two questions. First, one on the Works Council. Mr. Oslo certainly is a very influential man, and he's also a very emotional or maybe even sensitive man. What gets on your nerves more? And the second question is that the question where the power, electrical power for your electric car is to come from, moves you a lot. What would you expect from politicians? Well, it was in a press interview. Mr. Oslo is emotional and spontaneous at times and hard to predict at times for me, but he's also characterized by the fact that he knows the company like hardly any other and also knows its weaknesses and things in a very entrepreneurial way. So discussing with him, working on issues with him, does make things exciting at times, but it also gives you a lot of content. He does know a lot, and so all in all, I think we've done very well. What we expect from politicians, a focus on electrical mobility. Electrical mobility is the only way of attaining the climate targets looking forward, and we especially need help in building the infrastructure so that people living in apartments can charge their cars or can charge in public car parks. And this can be supported by public funds, biosubsidies. We need a tax system that also helps avoid emissions, and politicians are ready for this discussion, and the association also needs to go in this direction. You were very elegant in your answer, but I still can't really imagine what your personal relationship with Mr. Oslo is at the moment. You can gladly come along. I'll immediately come. Electric mobility and power. Well, it is a challenge to provide the power because we still have this high coal portion in our power production. You can look at it on various apps and on days on which there is little wind and sun. Not today. Today it's quite good, I think, but on other days the coal share is still more than 500 grams of carbon per kilowatt hour, and this is too much for electrical cars. Electric driving doesn't make any sense then. On good days, when we're down at 250 grams per kilowatt hour, it does make sense. An electric car is more efficient then, and with the exit from coal, the stage has been set. We're going in the wrong direction, but many countries are not that far. Others are more progressed. In the US, there is a lower coal share, or in France, there is nuclear power. But there are also other examples like Norway, Austria, and Switzerland who are doing clearly better. Spain has also clearly cleaner power than Germany, and this is a precondition for going electrical. But I think this is underway now. And of course, this is a task for politicians and also for the industry, this structural change. But it's manageable if you want to. So have a coffee with Mr. Oslo and Mr. Diess. It's planned. It's agreed. And then we have another question in the second row. And Mr. Ferrari then, well, be able to ask the last question. Thorsten Habke of NDR Radio. Two questions on remarks you made today on headcount reduction. You ruled out compulsory redundancies. On the other hand, you said it will be difficult to only rely on attrition and semi-retirement. Now, this sounds a bit contradictory. Is it right to say that in the short term you will rule out compulsory redundancies, but you can't rule them out in the long term? The second question is about this evergreen topic, the battery cell factory. You found a new wording today. You are reviewing participating in a battery production in Europe, but will it be your own, or will you be investing in one? I noticed when I read it out, and Mr. Sommer could comment on this. Certainly, we have a center of competence of our own, and we are beginning to study battery cell production and battery development. But there are also others who have achieved some very interesting things, so we're talking to them. Ultimately, we're putting something together which will allow us to bring about this immense transformation, the creation of this new big industry, so that it will become possible to do this in Europe, so that we can advance this aggressive electrification strategy. We will certainly contribute. Whether it will be a completely owned factory for ourselves, we will see. Two things concerning the first part of your question. Compulsory redundancies have been ruled out. Here for Germany until 2025, it's been agreed. We have early retirement. We have time banking. These are instruments that are very valuable. They find high acceptance among those age groups qualified for this. We also have to ask ourselves how many young people to train and on what occupations. So we have a whole set of tools, and we expect that we will use them. Of course, for early retirements, this is a voluntary thing, and we have to rely on acceptance. But so far, we've been quite successful, and we've started pretty early on. So we think we have enough time and we can ride the demographic curve. But it's not easy. It won't happen by itself. We're working on it, and we've made good progress so far. You know that our targets on early retirement for the Volkswagen brand, passenger car brand, has been achieved. We have the sign-offs. It takes some time until people will then retire, but it is an effective instrument, and we have embarked on this way. Now, one last question.
Hello. I have two questions related to CO2 emissions. The first one is, what is the current CO2 emissions average of Volkswagen Group brands? And the second one is that will all the Volkswagen Group brands will avoid penalties or sanctions in 2020 or 2021? Thank you very much.
In 2018 haben wir 123 Gramm CO2.
It was 123 grams of CO2 as the European fleet average, so we're still pretty much off the target, but we're going to attain the target, especially based on electrification. You asked about the value for France. I don't have this. We'll have to check on this. And what else did we have?
Could you once more give the last question?
Yeah, we will avoid sanctions. We will avoid sanctions.
Avoid penalties. We will avoid sanctions.
Penalties or sanctions?
Yes.
All the brands of.
No. We will be able to avoid the sanctions. Yeah. This is our plan.
Meine Damen und Herren, ganz vielen Dank.
Thank you very much indeed, ladies and gentlemen. This was the 2019 media conference. We'd like to thank you very much for attending and being so interested. If you